Hi, this is Isaac with Cordant Wealth, and this is our market update for the second quarter of 2021. So, as always, a lot going on in the quarter. We had obviously economic reopening still happening. We had vaccine efforts and COVID cases still in the news and still something that are needed to pay attention to from an economic perspective. Inflation was a big topic in the quarter, and then some proposed tax changes by the Biden administration. And as you can imagine, something that definitely we're keeping an eye on and needs to be paid attention to and incorporated into financial plans. So that's what's going on in the quarter. What we're going to hit here in this market update is a few things. So as always, we're going to look at just the performance of the markets in the quarter. We're going to focus in on a topic around inflation and interest rates, which, as I mentioned, was a big topic in the news over this last quarter. And then we're going to look specifically at debt levels. That's something obviously that people are concerned about. And take a look at just where the debt is from a government perspective, corporate perspective, and a personal balance sheet perspective. So that's what we're going to cover. So stay tuned and we'll get right into it. So, how'd the markets do in the second quarter? Well, it was another good quarter for the markets. U.S. market was up about 8% in the quarter and pushing total returns, at least here in the U.S. for the year, up 14% and change. So, another good quarter in the market. It's third quarter to date. I'm recording this a few weeks into July, and markets are holding on to a slight gain in July, but this week things have been a little bit more bumpy. So, good quarter in Q2, and let's break it down and take a look at how different areas of the market actually performed. So what you can see here is the best area of the market in the second quarter was global real estate, up about 10%. U.S. stocks checked in at an 8% return. International stocks up as well, a little bit over 5%, and emerging market stocks up just over 5% as well. To note, bonds were down in the first quarter. They're actually up a bit in the second quarter. U.S. bond market up just under 2% in the second quarter. And as you probably can remember, bond returns are up as interest rates fall. And that's what we saw in the second quarter. We saw interest rates come down a little bit. And that's something that we're going to talk about here in a little bit. But just to note, stocks and bonds both up in the first quarter. So looking a little bit closer at different areas of the market, we'll start with the U.S. stock market. So what you should note here, best performing area of the U.S. stock market for the second quarter was large cap growth stocks. Worst performing area were the small cap stocks. So value, small cap in general, and then small cap growth being the three lowest performers in the quarter. Now, year to date, you remember first quarter was actually a pretty good quarter for both small cap and value stocks. And so year to date, small and value are still slightly outperforming their counterparts after a good Q2, but what we did see after a good Q1, but what we did see is a bit of a reversal in the second quarter in the U.S. So that's how the U.S. Stock market performed. And just a refresher, at this point now, there's been some outperformance in the U.S. market over the last really 5 or more years. U.S. market's up to about 58% of the total market cap of the world stock market. Now, checking in on some of the other areas of the market outside the U.S. So what we see here, international stocks making up about 29% of the global market. Again, growth outperformed in the quarter, and value and small cap were the laggards. If we flip over to the emerging markets, in emerging markets, a bit of a different story here. Again, emerging markets were up in total about 5% in the quarter, but small cap was actually the best performing area in the internet or in the emerging markets for the second quarter, up about 11%. Now, shifting a little bit from how the market performed in Q2 to our topic that we're going to focus on, which is inflation and interest rates. So first of all, what you might remember is at the end of June, we got the consumer price index data and actually saw the highest inflation number that we've seen since 2008. So up 5.4% year over year in an inflation number. Now, one thing to note there is a big piece of that was this phenomenon that's going on in used cars with a huge price increase there. So that actually accounted for more than a third of the increase in total in the data for June. So what you hear a lot of is this phrase that it's transitory. it's temporary, it's not permanent, this uptick in inflation. And certainly there's a lot of debate around that. Is inflation something that's here and here to stay, or is it something more temporary due to supply chain shocks with the reopening and some of these phenomenon that are going on, such as used cars? So definitely a jury's still out on that. But if you look at just what the bond market did in the quarter, yields were down slightly. So what we're looking at here is three lines, the bottom of which was the interest rates at the end of the last year. The top line was the interest rates at the end of the quarter and end of the first quarter of 2021. And then that middle line is the end of last quarter. And so what you can see there is in the quarter, interest rates have dropped a little bit, which, if you believe the bond market is saying, yeah, we don't think inflation is going to run away, is going to be exceptionally high, and they do view this as transitory. So, time will tell. We shall see. But again, market expectations are for inflation not to get out of control here. So another way to look at this is just basically the pricing difference between an inflation protected bond and a regular bond. And what the market's pricing out over the next 5 years is for inflation to be just over 2%, about 2.2% based on this. So certainly market expectations for inflation are not high, and they're viewing that 5.5% number in Q2 for CPI as something temporary. So we'll see. Now, the last thing that we wanted to look at in this investment update is just debt levels. So we hear a lot about federal debt, federal spending, and the debt being very high. Wanted to put that in a little bit of context. And some of this comes from economist by the name of Steve Keen. He's done a lot of research into just debt levels, the impact of that. And from his view, really the corporate debt or potentially the household debt being more dangerous to the economy, and most economic, recessions or crashes have been driven by a private debt bubble, not necessarily a public debt bubble. And that could be part of the reason that the market is not pricing in a lot of inflation, even though we've had a lot of debt issued over the last year or so. So wanted to get into that a little bit. So here you're looking at two lines. The green line is just the private debt. So that would be corporations and households relative to GDP. And then the bottom line, the blue line is public debt. So this is federal debt relative to GDP. So what you can see, both have increased over the last year, but a main point here is just the private debt exceeds public debt out there, and that's not a lot. That's not in the news or in the headlines a lot. A lot of times you just hear about that public or the federal debt. So that's kind of the first point there. I wanted to look at more detail on the different components of that total debt. So first, just on the household level. So mortgage debt. This is something that obviously was a big trigger for the last recession in 2008. What you can see here is mortgage debt is nowhere near the levels it was in 2008. So households seem to be in good shape there. If you look at consumer credit, big spike at the beginning of this current recession, 2020, and has come down. It's a bit higher than 2008, but not at a really elevated level, especially when you look at it relative to income. So this is just total consumer debt. So that would include credit cards, car payments, mortgages, etc., relative to income at pretty reasonable levels there. The business debt, on the other hand, is a little bit of a different story. So again, these are business borrowings. So corporations, businesses borrowing money to either finance their operations, do acquisitions, etc., etc. And what you can see here relative to GDP definitely has increased here recently. And even if you look at it relative to profits, so this is something different that we saw on the household balance sheet is relative to income, household balance sheet low, business relative to profits, borrowings are higher than we've seen recently. So main point here is this remains something to keep an eye on. We hear a lot about the federal spending and federal debt, but business debt levels are something to keep an eye on, and potentially, more impactful on the economic cycles. At least if you pay attention to the economist Steve Keen, and he had a recent interview on the Bloomberg Odd Lots podcast that, if this is interesting, you might want to check out more. So that's it for our market update for the second quarter of 2021. As always, hopefully this is helpful. Hopefully it's informative. And if there's anything you want to hear us address in next quarter's market update, feel free to reach out. Just send me an email and we'll look to include that. Okay, thanks. Hope you have a good quarter. Bye.